All right, hello traders. James Stanley with StoneX and FOREX.com here for the US opening bell. It's Tuesday, August 11th, and we are now just 23 hours away from the US CPI print. This can be a really big deal depending on how it hits. I don't want to try to blow it up into something that it might not be, because the fact of the matter is, in many cases, we get these data points that come in right around the expectation, and well, the market response doesn't necessarily have to be huge, but there are some massive items that are loaded up for this one, and I want to go over that in the session. Tomorrow when we meet, we'll have that US CPI data print, so we'll be able to look at how some of these repercussions have played out. So let's get to the charts and start taking a look. First and foremost, want to highlight what we're looking for. So on headline CPI, this is the big deal. This is the big one. I'm going to show you a chart in a moment that will show you why, but it's expected at 3.4% from a prior month print of 3.5%. Core has been relatively stable. We're looking for that at 2.5 versus a prior print of 2.6. Now, after this, we're not necessarily done yet. We get PPI on Thursday morning, and then on Friday, we get a couple of important high impact data pieces out of the US with retail sales and U of M sentiment. And given how strong the US consumer has been, given that Atlanta GDP now forecast from, well, recently, there's going to be a lot of focus on the US consumer. So, it's not a one and done with this CPI print, but like I said, I try not to make these into a bigger deal than they need to be, because it's one of those things where you might get all built up for some massive volatility that just may not show. That said, it's a big driver right now, and this, I think, will help to explain as to why. This is US CPI going back to 2021, and you'll notice this is when the Fed was saying, oh, it's supply chain related, it's transitory, we don't need to address it. There was still the COVID hangover, all the stimulus from that. That's what I think at least a few members on the Fed are trying to prevent. We had this spike earlier in the year in headline CPI, and that's what I think has them a little bit freaked out. So let me give this a little bit less scope so that we can put this onto a relative basis. So I'm just going to focus this down, say, since like January of last year. Just clean up the data a little bit so that we can focus on what's most relevant. There we go. And so this is why I think it matters so much, because we had headline CPI in a relatively stable place between about a 2.5 and 3. But it was this flare earlier in the year, and that's what compelled the Fed to sound more hawkish in June. That's what led to that shot of dollar strength. That's what led to the dollar yen breakout, which in turn led to the dollar yen intervention. The softening last month, it's encouraging. But like we've heard from many of these Fed officials, if inflation remains consistent, if it goes back to that type of cycle we had in 2021, they want to have an open door to be able to hike rates. And, again, it's this recent flare in headline inflation. Now, headline inflation includes energy, includes food, so highly sensitive to the Iran war. Core, however, strips out food and energy. It's been a lot more stable. And I think arguably this is the more worrisome component, because it's not necessarily just oil prices, it's the flow-through effect of those. Because in the States, many of the products we buy at the store get there via trucks. So there is a flow-through effect of higher oil prices that could cause inflation in widgets, for instance, because the widget has to get from the factory to the store, and if the transportation cost to get it there is higher, then that's going to usually pass through in the product. There's not evidence of that yet, as we've essentially seen a relatively mild impact on core CPI. So there's some slack in here. But again, tomorrow the expectation is for this to come in at a 3.4% for core CPI. It is expected at, right there, 2.5% from a prior print to 2.6. So where this rests, I think if we get something like 3.3 or lower on headline CPI, I think there's a valid reason for USD bulls to start to bail. If we end up with this at a 3.5 or higher, so matching the prior month print, that's something that could evoke a little bit of fear. And that fear could play out in a few different venues. This is the conduit of that. We looked at this yesterday. These are rate expectations going out to the end of the year. And really what was the shocking value was back in June. June is when we saw inflation flare, Fed sounded more hawkish, and that's what really changed us from looking at possible cuts into possible hikes. Right now, it's a veritable coin flip for September. Into the end of the year, we're looking just about 77.9% probability of at least one hike. So again, there's a lot hanging on this print, especially if it comes out in the right way. In the dollar, it is a very similar situation that we looked at yesterday, where the dollar has beaten down into this support. So for this to break through, I think we're going to need to see that CPI print come out, especially that headline CPI print come out well below expected. If it does come out, say like a sub 3.3 or lower, I think there can be a knock-on effect, a repercussion starting from dollar yen. Hello, Latanya. Good to see you in the room. So I still think the dollar yen is the main driver here, but if that comes out 3.3 or lower, I think that could possibly compel a breakdown setup. But I want to bring in an outlier scenario in here for a moment, because the Bank of Japan is not stupid. And this is an event that I talked about quite a bit. It's a parallel to July of 2024. If we go back to July of 2024, the yen was just persistently weak, and dollar yen was persistently strong. The Bank of Japan intervened here at 160 in April, brought 1 week of pullback. Bulls just loaded the boat. And they loaded the boat because the carry was still on the long side of the pair. There was still incentive for underlying carry traders to have hedges on yen positions. And that's one of the things that sent dollar yen back up to 160. Notice when it gets up to 160 a second time, the BOJ doesn't just stand there and automatically intervene. They waited. They waited until the morning of a US CPI report right here, Thursday, July 11th. And that was like a perfect storm. Almost, I mean, I think it worked out too well for them. Not only did they intervene that morning, but we also got a below expected US CPI print. That below expected US CPI print right here built up expectations for rate cuts in 2024. And before you know it, there was adequate reason for longs to finally bail out of that position. And then you could see as we broke through those supports, it hurried and hustled lower. Classic example of unwind is this thing sold off by like 2,000 pips in just a couple of months. Finally finding some support just like 2 days before the Fed started cutting rates that year. But again, the BOJ, they're not stupid, and they don't want to waste their finite FX reserves on interventions that aren't going to work. Now, at this point, they've intervened. They pushed this back a bit, but they've also had some help with intervention from the US Treasury Department. So as we go into this US CPI print tomorrow, I think this is something that the BOJ will be watching. If we do get a better than expected print, or maybe even if we just match that 3.5 from last month at headline, that could be rationale for short-term bulls to push this move. Essentially on the basis that they don't think the BOJ will react sub 160. And this is most recent rollover rates that I just pulled from this page. Dollar yen still positive on the long side, negative on the short side. So I mean, literally at this point, there's like a disincentivization for shorts to hold and an incentivization for longs to hold, and so we could see why there's been this clawing back on the long side. But if we get back up to 160, maybe the BOJ is ready to swat this back down. Maybe the Treasury Department is ready for another rate check or something along those lines. It's become obvious that both sides, both economies in the pair, want to see this spot price lower. I covered this in a video just after the intervention. At a 155, it doesn't make sense for them to intervene. Even at a 158, it doesn't necessarily make sense for them to intervene. But as we get closer to a 160, as it starts clawing back, maybe they don't want to wait for a 164 or a 165. But I think this is the X factor behind the dollar. And I think that does add a degree of vulnerability. And that's one of the reasons that I think that the dollar has had a difficult time trying to recover, even though it's been just hanging around the support over the past couple of days. That said, this zone right here is huge, 100 spot 22 up to 100 spot 40. You take a step back. This has been a zone that's been in play for a while now. This is the lows that were in place right around when the Fed started cutting rates. Perfect example here, by the way. Fed starts cutting rates. They cut 100 bips in that cycle, and in the final portion of 2024, yet USD rips into the end of the year, as does dollar yen. But that's a big spot that's played a major role. Resistance, resistance, resistance. We finally got above it. It tried to hold support and failed, but that's resistance on a pullback type of setup. to look for. On downside, we essentially got to seek the zone that's around that 99 handle. We get below that, then we're looking at price reverting back to the longer term mean, longer term range, and right around 98 is what seems to be about the happy spot there. Dollar yen, I still think this is a major push point. The yen's only 13.6% of the DXY basket, but when you look at how loaded up this is, I mean, going back to, let's go to a cleaner chart, going back to 2021, I mean, we're still like 50% higher. That's some pretty significant yen weakness. That's some pretty significant trend in a major currency pair. There's reverberations of a move like that. You can see off of this weekly, it takes on the tone of something that is looking prime for bullish resumption. Indecision last week, so far continuation. If we get halfway up the body of this candle, so if we get above, like, say, like a 161 area, it's going to start looking like a morning star. Now it's a weekly, there's a lot of time to go, but this is yet another reason that I think there's rationale to be cautious, especially on tests above that 160 handle. But I'm still of the mind that as goes dollar yen, so goes the dollar basket, and I think that's something that could push, even a market like euro dollar, which is generally larger. The euro is a 57.6% component in DXY. Yen is only 13.6, but there's still a lot of longs that are holding on in here. That rollover is one reason why retail might, but if you think about it from the institutional perspective, there's still significant rate divergence between these two economies. It's like a loaded deck for Japan to be hiking rates, given their demographic concerns. And when we do get these situations, these episodes where we get stronger US CPI data, higher probabilities of US rate hikes, that just widens that divergence. And as a case in point, June 10th was the US CPI print that really started to surprise. And you can see that's finally what got us this initial breakout at like 160.64. And then it was a week later, FOMC right here on the 17th, that propelled the next portion of the breakout. Interestingly, notice that it was the Asian session that night when this breakout really took hold. And then ultimately ran into that 160 test, the breakout that compelled that intervention. But big setup, big backdrop here in dollar yen, and I think this is going to have a lot of carryover across the USD basket. At this point, again, we just got to call this what it is. On pullbacks, short-term support, there still is a bullish argument here, right? And you could see the reaction to NFP last week. That NFP number was nasty. Contraction when we were looking for expansion. The initial response was pretty violent, but bulls just came right back in. They bought the dip because, again, there's not really a lot of expectation the BOJ is going to intervene into 157.50. The bias is still on the long side of the pair given rate differentials, and so bulls just take it right back up. But as we get closer to these thresholds, they get more and more cautious, as illustrated by the slowing of the move up here. But US CPI has had an incredible impact on dollar yen over the past couple of years, and that's something that is very much a scenario to entertain as we go into tomorrow. That said, there are setups in other major pairs. Euro dollar. Let's go over to this one. There we go. So going into FOMC last month, we had this in a pretty clean falling wedge formation. That falling wedge broke out in a very big way at FOMC. Major shot in the arm around the yen intervention. And so far, it's been bullish continuation, still higher highs, higher lows. And from the daily, I think that argument still holds. There's a couple of zones here that could be tested for higher low support. To negate that rally, I think realistically, we're going to need to see a daily close below 114.55, where it's going to start looking more and more like failure. That's a situation I have a hard time buying behind, because if we see the dollar that strong, it seems to me as though dollar yen will probably be above 160, and that's where it gets in that kind of that danger zone for an intervention type of run. But the beauty of price action is the chart, and until that changes, it's what it is. So higher low support ideally I think plays in this zone from like 114, let's call it 115 flat up to 115.15. Pretty comfortable little zone of support, came back in. So far has held the higher low, but we get a pullback in there. That's something that keeps the door up for bullish continuation. up above price right now, 115.76, 116.13. This is a zone I've been tracking for a while. It simply just takes, kind of this messy area back here in March and this peak low in May. But I've been following that. Ultimately, that's what caught the high on the rally last week. If we get above that, 116 could still present some challenge, but that would be what bulls need to show to illustrate that they are taking control of the matter. And then above that, it's right here, just inside of the 117 handle, 116.70, 116.86. That is the next spot of resistance that I'm tracking on the pair. Cable. So looked at cable yesterday in the opening bell, and again, really similar backdrop. When I was looking at it then, we had the 135 handle. As I shared, this is something I'm still looking at as bullish. We had an ascending triangle at the time. We did get the 135 break. We so far had the pullback. We've had the support around the 135 area. So from a trend perspective, you can still argue this is bullish. The challenge is that 135 level that we're trading above right now. There just hasn't been a lot of great history with cable at 135. That said, I do think this is a tributary of that larger dollar theme and that dollar yen theme. So if we get some yen breakdown, or we get dollar yen breakdown and USD breakdown, I think this is something that could shoot this pair higher pretty quickly. That said, tough spot to start chasing it right now. You would essentially have to look at this as like a tight leash type of scenario, given that we had the higher low at prior resistance right in there at like 134.84, and we're holding right at that 135 level right now. It's in play. But it's, again, the beauty of price action is that it's relatively objective. Of course, there's, eyes of the practitioner, and it could be, biased or skewed in a multitude of different ways. But, a fresh eye is a fresh eye. A hold of support of prior resistance is a hold of support of prior resistance, the kind of thing you want to see on the long side of the pair if you are looking in that direction. So, this might have a better argument for USD weakness than even euro dollar. If we do get about $1 strength on the back of that CPI print tomorrow, then there's subordinated support down here at like 134.70, which is ideally what I'd want to see hold so that trend line remains in place. If it punctures that, then this is around what I'm talking about for invalidation, around 133.90, which I know it seems kind of messy, but it was resistance on multiple accounts, and then it was defended for support right in here as bulls came in around 134. So we get a closed body break on the daily below that. That's where it's going to start looking like it failed. Till then, there's bullish justification on this thing as far as I'm concerned. Daily, this is where it gets a lot messier above that 135 handle, but notice that 135 is not like, it's not like 164 in dollar yen that was widely defended, so it can venture up there relatively fast. But I think the reason to consider this is if we do get that break, it's something where I don't want to just necessarily hang around. I want to look at like a scaled profit target type of scenario so that I'm taking a piece off without necessarily removing the entire position, so that if it can juice up to a 36, 37, or maybe even like a 37.50 or possibly a 38, then, I want to have something that could possibly play on that front. Largely because of this, go out longer term. That resistance trend line has been holding for a while, and eventually if we get the breakout, it's something that could run for a bit. It's not quite there yet. Aussie dollar. This is another one that I like for USD weakness at the moment. We had the RBA rate decision last night. You can see the response in there. It's a very similar backdrop to what I looked at yesterday. We are just holding right here at the 70.5-ish area. But notably, we did not get down. We did not dip down for a test of that 70.21 or that 70 handle. So, at this stage, if you pop this back to a weekly, I think you could justify this on the short side, largely from the basis that we have a hold of resistance around this area of prior support. Shorter term you get, I think the more bullish this begins to look, largely because it's been mostly up so far in Q3, very sequenced setup of higher highs and higher lows, with that line in the sand remaining overhead. But, again, I think this is going to be highly contingent on other factors, not necessarily Aussie related. As a case in point, RBA, and, we're roughly looking at piano keys over the last couple of days, right? We're right around where we were yesterday. But I love the trend that we've seen over the past couple of, past month and a half. And I think that's something that could possibly play, especially if we get like a dollar breakdown tomorrow on that US CPI print. Dollar CAD. This is one where I'm still a little bit more warm for USD strength, largely on the basis of the fact that we've had this element of stall around the 139 handle. Now, that said, this is a contrarian type of look because it broke below a big level on Friday. And that was a big level that it was working on for a while. But notice what happened in here, the way that that breakdown hit. We had this posturing, this hold of support right in here. I mean, it's not like sellers were all of a sudden evacuated. We got down to slightly lower lows before that pullback hit. This time we actually penetrated 140 and then we bounced again. This time we penetrated 140. That bounce was heavily sold short. But notice what's not happening right now. We got the low on Friday. We had a low on Thursday, or on Monday. And it's not like a massive difference, but 139.258 on Friday for the low, 139.267. So it's literally like 9 pipettes of difference between the low Friday to Monday. And so far today, that's been defended as well, 39.283. So we're not getting the lower low sequencing that was here. We're getting the higher low sequencing. This indicates to me that we're seeing shorts cover up positions, and there might be a building case for a bounce. If this daily bar finishes, let's say like right around 39.75, then it's going to start looking like a morning star. And that's something I think that could be more attractive for a bullish reversal type of setup. Not quite there yet, but I like the possibility of a turn, especially I'm looking for USD strength at the moment. I also like that for that to come to fruition, I'm not necessarily going to need to look for like a giant leap of faith in the dollar because, again, if we get that extended USD rally set up, then in my mind, I'm imagining that's driven largely by dollar yen going back above 160. And then it feels like it's kind of playing with fire at that point. Besant came out with multiple comments on the matter. There's the old saying, don't fight the Fed. In this case, it's like, don't fight the DOJ, don't fight the U.S. Treasury Secretary, don't fight the U.S. Treasury Department. That feels like a tough trade to get too comfortable in. So, maybe something on like short-term scalps, like a short-term setup, scaling out on the way up. But, it's not anything where I want to give it too long of a leash because that's something that might get hammered really, really fast. On that front, and something slightly away from the FX sphere, gold. So I follow gold pretty heavily, and I'm of the mind that gold has a tendency to try to look around the next corner as well as it can. And as a case in point, if you saw what happened back in 2024, so like initially 2K was a hard line of resistance in gold, and it held for a while, like 3.5 years, right? It finally started to peak above in December of 23, and that's right around when the Fed was talking about rate cuts in 2024. Now, at the time, inflation was still way too high. I mean, we could look at December 2023, right back in here, 3.1% on headline, 4% on core. So inflation was still way too high. But, and keep in mind these prints, I'm going to get into these in a moment too, like February of 24. These were the month that it was released. So February of 24, the print was 3.1, headline 3.9 core. Pretty large prints, right, for a Fed that's got a 2% target. But when we get into 2024, the Fed's forecasting that they're going to start cutting rates that year. And it was a US CPI print. That's why this is relevant here. It was a US CPI print right here on February 13th, 2024. It came out well above expected. And again, we could take a quick look. It was well above expected. It was released right in here. 3.1 headline, 3.9 core. And markets freaked out a little bit. The dollar ripped. We saw stocks sell off. Gold dipped. It was the first time gold traded below 2K in 2024. The first time they traded below 2K since the Fed rate decision when they were forecasting rate cuts in the next year. A day later, Austin Goolsbee, Chicago Fed president, in a media interview says, let's not get all flipped out about one inflation report. It wasn't one inflation report. I mean, you could see from the data, right? The month before, it was excessively high. I mean, we weren't anywhere close. We weren't sniffing the Fed's 2% target. But all of a sudden, you get, a widely watched economic personality on TV saying, forget about the data that doesn't go our way. And then gold breaks above 2K a day later. That speech was on Valentine's Day, by the way, or that interview was on Valentine's Day. It breaks above 2K and it just rips and rips. And then the Fed starts cutting rates in September. Gold's still ripping. It was up like 40% or 25-ish% at that point. Ultimately gets up just about 40% higher before it ultimately tops just a week before the US presidential election. But, this was gold sniffing out that Fed dovish twist, even with high inflation. And we get into the next year, 3,500 is where gold tops. This is when Powell was not sounding too certain about rate cuts because inflation was still too high. August 22nd is when he finally opens the door, saying that he thought it was around time to start cutting rates. Gold rallies, breaks out in a very big way. And that continued all the way into the new year. Now, for much of this year, gold has been digesting that prior move, but it broke out in a big way last week. And I think there's a couple of different things going on here. But I think this is markets saying that this flare in inflation isn't enough at this point to put the Fed in a spot where they're going to tank the AI trade, especially given that President Trump just named his chosen successor of the Fed, and along the way said a willingness to cut rates was a litmus test for whom he was ultimately going to choose. Gold put in his largest move since it had topped back in January. And at this point, it still has short-term bullish technicals with a pullback so far. It's held support at prior resistance. It's trying to chew through a really big area right now around 4380 that was resistance turned support. So 4380 up to 4400. That weekly bar or daily bar right now is not what I want to see. If you get indecision after a large run, it's going to start looking like it's prone for a pullback. But like we saw here, it's not quite a doji, but indecision isn't necessarily predictive of change. Which is why the shorter terms could come in as a default look. But a couple of areas I'm looking for if we do get pullback. So like, let's say this CPI tomorrow comes out, even if it's just in line or maybe a little bit hot, if there's enough rationale for dollar strength, I don't necessarily think this is going to get us a September rate hike. So that opens up these two areas for higher low support potential on that breakout move. Right around 4,300, and this zone's pretty juicy. We had a couple of swing highs in there, lower highs before ultimately this thing turned. 4166 up to like 4195. But that, my friends, is what I'm looking at going into CPI tomorrow. As always, I appreciate your time. I wish you the best of luck. We will convene tomorrow after the print. As always, happy trading, ladies and gentlemen.